From New York City for our viewers worldwide, I'm Katie Greifeld. Futures taking a bit of a breather on this triple witching Friday. The countdown to the open starts right now. Coming up, it's triple witching. Traders brace for volatility as $5.5 trillion worth of options set to expire. Business activity loses momentum in Europe on French election fears. US PMI numbers out later this hour, and expensive markets stay expensive. We'll speak to the biggest bull on the street, Julian Emanuel, about why he raised his year-end price target. We begin with the big issue, the AI-driven stock rally taking a breather.
I think markets are a bit priced to perfection, if I may say, so all this Goldilocks scenario. But as long as we get the earnings in place where expectations, I think, are quite high, I think that's sustainable. But if there is some disappointment on the earnings, then of course there could be a kind of consolidation in the market.
Joining us now is Young-Yu Ma, BMO Wealth Management Chief Investment Officer. And you write in your notes that May's CPI report, it was a psychology shifting reading. Describe to me what you meant by that.
Yeah, it's great to be here. Thanks. Well, we think that May CPI report, where the headline CPI came in at 0% increase on the month, is really going to get people's attention and has gotten people's attention and gets the idea in mind that we are resuming this downtrend in inflation. And we're seeing that not just in the US, we're seeing that globally as well. And we think that's what's helping to prop up the market and support this next leg higher that we think will happen over the summer.
Well, tell me why that matters, because you think about Fed rate cut pricing, for example, it's been all over the place this year. So when you think about inflation to cut pricing to the actual stock market, does this market actually need rate cuts at this juncture?
That's a great question. The market has actually shown us that it does not need rate cuts. The market has done surprisingly and even amazingly well this year in aggregate without any rate cuts happening so far, and with the prospect of rate cuts has been kept getting pushed out further and further. So we think what actually matters most is the trajectory of inflation and that longer term consideration of where inflation is going to fall, where rates might ultimately fall, whether we get a rate cut in September, December, one rate cut, two rate cuts. We think that matters quite little for the markets, but this downward trajectory of inflation, resuming that path, we think that's what's going to be most important and what the market is going to key off in these summer months.
Well, let's talk a little bit more about the trajectory of inflation and a slew of Fed speak in the last few days. And, of course, even more eco data on deck. Mike McKee, Bloomberg Chief Economics and Policy Correspondent, joins me now. And I want to highlight Austin Goolsbee saying that the Fed can cut with more inflation reports like what we saw in May. It really seems like May is the blueprint here.
May is the blueprint, and that's what pretty much everybody has been saying from the Fed this week. We had 10 voting, well, not 10 voting members, but 10 members talking about the economy. A couple others spoke on other topics. And basically what they said was what everybody has been saying, that if we get more reports like we got from CPI and what they're expecting from PCE, then they may be able to start thinking about cutting. There are some trades out there for July, but that seems still rather far-fetched given the Fed speak we saw this week. So maybe September is what to look for when we get the PCE report next Friday and then CPI in the middle of July. Things to keep an eye on. Meanwhile, today, there's not a lot to trade on, but we do get the S&P global PMIs for the United States. And here's what happened in Europe. Almost every single one of them went down. And it wasn't too long ago, just last month, that we had a bad PMI report on manufacturing, and it set the markets lower. So it's something to keep an eye on. That's at 9:45. I'll be back with those numbers for you. And then at the top of the 10 o'clock hour, Katie will be giving you the housing numbers for existing home sales. And that's an interesting number because while the markets have priced the fact that nothing's happening, when you look at what is not happening, it's kind of bad news for the economy overall. This is non-seasonally adjusted and seasonally adjusted sales, existing home sales. And look what happens. This is the time period when we are supposed to see the white line going up, which is the seasonally adjusted sales, because this is the peak of the spring selling season, and it's not happening. And so if that doesn't change, we're still going to get deeper into this housing hole the U.S. has.
Well, Mike, I know I'm talking to you in 40 minutes time, but before I let you go, something I've been thinking about this week after what we saw from the Swiss National Bank, how it was kind of a coin flip going into the decision. And of course, we ended up with a surprise rate cut from the SNB. When it's time for the Fed to cut, I just feel like we'll know that they're going to tell us in pretty certain terms when that's actually coming.
Oh, sure. They will start making it plain. We've got a Fed meeting at the end of July. We have the Fed Chairman Jay Powell testifying in mid-July, and then we've got the Jackson Hole Conference at the end of August. So if they're looking at September, many opportunities for the big guy to give us some hints toward that. And of course, the rest of them will be speaking as well. They don't like to surprise like the Swiss do. So the markets will be volatile, but we'll get advance word from the Fed.
Yeah, plenty of opportunities to set the table for that first rate cut. Mike McKee, we'll see you in just a little bit. Let's get back to Young Yu Ma of BMO Wealth Management. And as you were saying, it's the inflation trajectory that matters more than the rate cutting trajectory. And talk to me about why that is. When you think about the psychology of the C-suite, how does falling inflation actually work its way into the stock market?
Well, in a few ways. One thing is that stocks are long-lived assets and very long duration assets. So if we're actually looking at what's a fair value to pay for stocks and what's reasonable, investors are rationally going to be looking at a longer term trajectory and where the ultimate level of interest rates are going to end up, not so much where they're going to end up at the end of the year. If you talk about the C-suite, I do think that the C-suite just wants to see that trajectory to be comfortable with more spending plans, greater expansion, and to be confident that the soft landing has actually happened. And once that confidence really sets in, we think companies are going to turn more toward growth mode. They've been in cautionary mode for quite some time. And once they turn more toward growth mode, there's going to be an additional jolt of spending in the economy that's going to be helpful for overall growth.
So what do you do until that point? Do you just buy tech, for example, where you have companies spending billions and billions, if not trillions of dollars on things such as AI?
Well, that's certainly where a lot of the money's been flowing. It's been very much a one-way trade so far. We do think as inflation continues to moderate and the Fed does start to get a rate-cutting campaign by the end of the year, we do expect the market to broaden out. But really just staying invested here, not being shaken out of the market, especially as we start to, in the third quarter, approach the election season, which could inject its own dose of volatility, really just focusing on the underlying fundamentals, which between earnings growth, which look to be accelerating, between stable underlying economics, we think there's a lot of reason to be optimistic here still, despite the run-up that we've had in tech. And we think we're in the relatively early innings of the AI boom. So even though there's been a big rush in the space, we don't think we're near this being played out.
And where do you also see opportunity? I mean, we talk about tech all the time. We could talk for the next hour about tech if we needed to. But outside of just that sector, I mean, where are you looking right now?
Well, there are some other areas that do benefit from the tech spending as well, or the AI spending, which is infrastructure and improvements to the electricity grid. So there are some industrial companies and part of the industrial sector that focuses on infrastructure really benefits from that. We think a lot of companies are actually going to benefit from the productivity gains, which we think will start to be apparent in the data probably next year from implementation of AI. So we expect this to be much more broad-based than we're seeing in the early stages. In the early stages, the number of winners tends to be relatively narrow, but we think this is going to broaden out as we go throughout toward the end of the year and into next year.
Makes a lot of sense, of course, just buy the sectors where big tech is spending money. But let's talk about what you don't like, because I found this curious in your notes. You write that you're cautious on consumer staples. And I found that a bit unintuitive, because you think about the state of the economy right now. You have relatively sticky inflation. Prices are much higher than they were just a couple of years ago. And you have a pinched consumer. Wouldn't it make sense that consumer staples would kind of be the play here?
Well, there's a lot going on in consumer staples, but we do see the multiples there as relatively high. The growth is low. And we do have some pinched consumers on the lower end of the socioeconomic spectrum, but a lot of consumers are trading down. a lot of consumers are looking for a deal. I think you saw that in the May retail sales numbers. And if consumers are looking for a deal, that's not necessarily going to flow to the top brand names that are a big part of that consumer staples sector. So we think there is somewhat of a trade down that's happening or likely to continue to happen in consumer staples, and that might pressure the overall area. And without much growth and supporting relatively high multiples, I think investors are going to look to where the growth actually is.
And do you follow that trade down? Is that an investable trend that we're seeing?
In consumer staples, is that the...
Or just when you think about across industries right now, you're seeing it in retail, you're seeing it in restaurants, for example, that trade down. I mean, do you go to those sort of lower rung, maybe discount sort of offerings?
Well, that's a challenge to do as well. That's a tricky trade to play. The trade down play is tricky because you might think that some areas should benefit, but it also turns out sometimes you find that those areas that get a proportion of the trade down play also lose a proportion of consumers because they're just strained at those lower end of the spectrum. We think that's just a tricky place, and you're probably better off just staying away from that trade down play, both for the companies where the trade down is going away from them and even supposedly toward them. It's just a tricky area to navigate.
Yeah, fair point there, that it's tough to pick the winners in the trade down scenario. But let's talk about what seems like it's been an easy trade over the past couple of years, and that's cash earning 5%. How are you feeling about cash levels right now when you think about overall portfolio allocation?
Well, we like staying invested here. We think the dynamics of the market between having earnings growth, a stable economic backdrop and labor market, inflation falling, corporations starting to spend more money, both on AI and otherwise. We like the idea of staying invested and not trying to hunker down in cash. But for those investors that cash gives some extra comfort to, we do think it is a big benefit, not just to investors, but to the economy overall, that you're getting a pretty good return just from sitting in cash, and it's a return that is well above inflation. So that is actually helping to support spending in the economy. I think there's about $140–150 billion per quarter that investors are getting just from bank interest paid on bank accounts relative to where we were a couple of years ago, and that just supports spending the economy. So overall, it's okay to hold some cash, especially now when you have the returns on those cash being much higher than inflation.
And as of the latest reading, $6.1 trillion still held in money market funds. Young-Yu Ma, really enjoyed this conversation. Have a great weekend when you get there. That, of course, is Young-Yu Ma of BMO Wealth Management. And joining us now with a look at the stocks moving ahead of the opening bell, let's get to Abigail Doolittle.
Well, Katie, the major indexes here in the pre-market barely moving, but beneath that benign surface, we have some outsized movers, including the shares of Sarepta Therapeutics, up more than 30%, heading to the best day in 5 years. This after one of their therapies for muscular dystrophy was approved for a broader purpose. Some analysts saying it's the best case scenario. Those shares right now up 33%. Again, the best day potentially in 5 years. CarMax also trading higher. They beat earnings for the most recent quarter just slightly. Most analysts saying it was an inline quarter, but with this reaction for the stock, it seems as though there's maybe a bit of relief. And then one reason we have futures down, NVIDIA heading to a potential second down day in a row. Yesterday down more than 3%. Maybe a little bit of consolidation of what had been a 180% rally on the year, still pretty close to that. And then, of course, Katie, you were mentioning the fact that it's triple witching, the rebalancing, lots of volume and volatility. That could also be a factor in why there's some repositioning in NVIDIA. That stock right now down in the pre-market.
Down in the pre-market, and certainly that's weighing on futures as well. Abigail, thank you. Now coming up, the SoftBank founder says he has plans to bring about an era of artificial super intelligence. More on those plans next. This is Bloomberg.
Shareholders, don't worry about that SoftBank share price stuff. Jim dreams a big dream. Why don't you support Masayoshi Son, who has a big dream? I was born to realize ASI. AGI stimulates AGI and drive evolution. Less than 10 years, ASI will come.
And that, of course, was the founder of SoftBank speaking at the company's annual general meeting earlier this morning. And for more on Son's ambitious plan to get into AI, we're joined now by Bloomberg Technology co-host Ed Ludlow. And Ed, it wasn't AI, it was ASI, which is artificial super intelligence. What exactly is that?
Well, by his own definition, it's AI that's 10,000 times more powerful than the human brain.
Oh.
It's an interesting moment in time for SoftBank, right? Because they are riding higher as a conglomerate or as a startup investor than they have done for quite some time, largely because of the performance of their investment in ARM Holdings, ARM being a chip design firm that has itself convinced investors it's going to be a central part of the AI story. And, I think you and I were talking off air about, well, what do we actually learn from SoftBank overnight? And if there's only one substantive thing, it's probably that SoftBank's bet on ARM is the focus of their AI strategy. In other words, they think that all of the chips that ARM will design will be leaders in the fields for data center chips or robotics chips or all the other hardware plays that we're seeing right now in AI. But what I found so interesting overnight is no matter how emotional Masayoshi Son was, he literally said to investors, root for me, I have a big dream. They were more interested in shareholder returns, which is a bit sort of beige, but important in this environment.
Yeah, according to our reporting, Son at times was visibly overtaken with emotion. And I mean, like you said, he laid out a really grand vision here. He obviously has huge ambitions, but not a lot of details on what the actual plans are here, Ed.
Yeah, I think a lot of investors would look at the share price. The Japan-listed shares are up, I think, around 60% year to date. Their net asset values have climbed back because remember that many of the bets that SoftBank has made on startups in all fields in recent years have not paid off. And they have recovered largely on the back of their majority holding in ARM. And so you look at the chart on your screen of where the elevated share price is, that is in yen. And lots of investors asked him throughout the AGM about stock split, share buyback, dividend. And he said, just don't worry about it. Don't worry about that. Think about my dream. I'm giving you my dream. But remember, in the background, Elliott, a familiar name to us on this program, has built a more than $2 billion stake in SoftBank. They're returning for a second time as an activist. And they just want buybacks. They want shareholder returns because you look at that chart, and to many, that would be justified.
And that just seems so quaint when you think about really super intelligence and the evolution of humanity. But even still, I mean, talk a little bit more about that pressure, because you think about AI and outside of course, our humanity, I have to imagine there's a lot of opportunity to make money in that space.
Earlier this year in February, some colleagues at Bloomberg News and I reported that SoftBank has this big ambition, or actually Masayoshi Son has this big $100 billion ambition to dominate the semiconductor side of the AI story. That might sound familiar to you because it's something that Sam Altman of OpenAI, we have reported, is also thinking of doing to build up a big war chest. And he was asked about that, Masayoshi Son, during the AGM. He didn't explicitly acknowledge the project's code name and the specifics of it, but basically said he will do whatever it takes to get there. SoftBank's in a position right now where, again, we keep the chart on the screen, the share price gives him some wiggle room to fulfill this vision, but it's just not of interest to shareholders. And again, I call it beige, but think about the euphoria around NVIDIA's stock split and the access to retail investors got as part of that. And some of the other valuations that are driven by AI right now, NVIDIA's trading at 45 times forward earnings. Investors are basically saying, well, how long is it going to last? And give us some money back on the table, please, because we've supported you thus far.
I do love that tableau of course, Son visibly emotional about sort of the promise of AI, and then you have shareholders saying, can we please talk about dividends? But in any case, you mentioned scaling up here, investments, et cetera. And I believe it was yesterday that we were talking about Dell with teasing this AI factory that they're going to build. And it just seems like there's an incredible arms race going on right now, Ed.
Yeah, the way I would think about it is quite clear that NVIDIA makes the GPU, the brain of what goes into a supercomputer that trains AI. And NVIDIA is kind of riding super high, but they have no experience or background in selling their products into the sort of rest of world channel. NVIDIA's stock performance and top line growth has largely been driven by 5 customers, which is the hyperscalers and Meta. Dell, by comparison, is very good at selling its products and services to small and medium enterprises and governments. And so basically, if somebody wants to buy NVIDIA GPUs or AI accelerators, you don't just knock on the door and say, Jensen, can I have some of those? You need an intermediary. And so there is some beneficial read-through that Dell and Supermicro and other server rack assemblers are going to get from that. The problem is that Jensen Huang also realizes this. He wants a bigger piece of the pie, and so NVIDIA is very much thinking about how they can just control the whole ecosystem themselves, become more of a systems vendor rather than just sell the GPU.
All right, Ed, it is always a joy to talk to you. You, of course, can catch Ed Ludlow on BTech at 11 a.m. Eastern. But coming up on this program, the morning calls, and later, Julian Emanuel, Evercore ISI, the biggest bull on Wall Street with a year-end S&P 500 target of 6,000. But on the topic of AI, here's Howard Marks of Oaktree speaking about it earlier on Bloomberg TV.
Obviously, there's optimism surrounding AI today, and it is to some modest degree pervading the market. But I think that AI will not have a profound impact on non-AI companies for a good period of time.
All right, it's time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. And first up, we have Bernstein downgrading Northrop Grumman to market perform. The analyst doesn't see any immediate catalysts on the horizon as the Department of Defense's budget gets constrained in Congress. Next up, we have Craig Hallam upgrading Penn Entertainment. The analyst says that M&A and activist interest provides a compelling opportunity for the stock, even still currently down about 1% in the pre-market. And finally, we have Monness Crespi cutting its recommendation on Palantir to a sell. The analyst cites the big data company's, quote, gluttonous valuation. And I mean, some of that is getting worked off right now. Palantir currently off by about 3.4% before the bell rings. Let's get a check on the markets. We are just minutes away from the opening bell. And you can see the S&P 500 taking a bit of a breather here. We saw its record run break a little bit yesterday, closing about 0.3% down and currently off by about 0.1%. Of course, we are still on track to close out a third straight week of gains unless something amazing happens. And of course, it is triple witching day, so you never know. But in any case, you take a look at the NASDAQ 100 right now, currently flat in the pre-market. And then small caps, we haven't seen this in a while, relative outperformer on the day. Now coming up, the biggest bull on the street. We'll speak to Julian Emanuel of Evercore about his 6,000 price target for the S&P 500. This is Bloomberg. All right, this is the countdown to the open. I'm Katie Greifeld. We are moments away from the start of trading. You look at where we stand, and we're a little bit lower on the S&P 500, down about 0.2%, pretty much unchanged on the NASDAQ 100, but still biased lower. And small caps, they were rising in the pre-market, but fading a little bit, of course, as that bell rings. So let's take a look at what's going on outside of equities right now. You take a look at FX. You can see Euro USD, that pair, down to 106 right now. You take a look at your 10-year Treasury yield. A little bit of a rally building in the bond market. 10-year yields currently off by about 3 basis points, and crude pretty quiet this morning, currently up by just 0.1%. Now, one stock to watch at the open is Spirit AeroSystems, soaring after a report that Boeing is near a deal to buy back the aircraft parts supplier. Abigail Doolittle has more.
And Katie, this, of course, isn't really new news. It's just confirmation of what we've been hearing for quite some time. Off of the September of last year lows, more than a double for Spirit AeroSystems. So again, some of this priced in. Right now, the stock up about 5.2%. So a very good day indeed. I'll actually be able to see exactly since how long using the SINS function within the Bloomberg terminal. It is the best day since March 20 of this year. So investors liking it. But the relief is about the idea that there is this report, Reuters saying that Boeing is nearing a deal to buy back the aircraft parts supplier in terms of of splitting the different programs, and then Airbus will take another. And then there's a possibility that a third category of programs may be sold or dealt with separately. Since this stock was spun out back in 2007 or so, into today, up about 30%. But between there and now, lots of moves up and down. I think investors really like the certainty of what's happening here, Katie.
Yeah, some needed relief for that stock, of course, down pretty mightily over the past year. Abigail Doolittle, thank you so much. Meanwhile, earnings season never ends because CarMax out with results this morning. Let's bring in Bloomberg's Jess Menton.
Well, taking a look at CarMax this morning, Katie, that stock up more than 3%. So this is a key company to look at because when you think about the Federal Reserve's trajectory with interest rates, obviously we know that when it comes to used car dealers, especially CarMax, because it is the biggest one in the U.S. and the pressures that came under, especially during the pandemic and then coming out of that, when it comes to new car sales, there's been a lot of improvements there just because a lot of those used car dealers have been issuing different sort of deals to get consumers to come back in. But when it comes to the used car side, even though you are seeing a profit beat there, but it offset a sales miss, when you look at this, especially when you think about affordability when it comes to some of these used cars, if you look toward the end of last year, the average was close to around $30,000. Now it's hovering around $26,000. So, of course, still pricey, but they are seeing those affordability improvements there, which is crucial. And especially when you think about what the trajectory of when it comes to the Federal Reserve potentially trimming borrowing costs later this year and what that could mean for the company. If you look over to some of its rivals, so if you look at, say, AutoZone, that stock is actually up just about 0.4%. We know Carvana can be quite volatile, but that stock's down about 1% there. And then when you look at the sub-industry group, when it comes to auto retailers right now, it's up about 0.8% for that group in the S&P 500. And of course, I can't leave out when it comes to buyback programs. It did reinstate that at the end of last year, and it said in this prior quarter that it did buy back about $100 million of stock, Katie.
All right, Jess Menton, always great to see you. Thank you for that. And in the next hour, we'll be talking cars with the CEO of Ferrari. That's coming at about 10:10 a.m. But before we get there, finally, let's talk about Sarepta Therapeutics soaring after the FDA approved expanded use of the company's gene therapy. Natalia Kniazhevich joins us now with more.
So the stock is up by 30% today. This is a huge win for the company. Basically, this gene therapy called Elevidys is for children aged 4 and above to treat DMD, Duchenne Muscular Dystrophy. It's been very controversial, this whole approval process. Basically, it failed phase 2 and phase 3, which is a benchmark. However, this therapy showed really good results during some of its secondary analysis. Eventually, FDA granted an accelerated approval process, which is basically a shortcut to get drugs for devastating diseases to the market. So this drug therapy has been available on the market since last year, but only for children, to treat children 4 and 5 year olds, but now it's approved for patients who are at least 4 years old, but with no upper age limits. What it means for the company, basically that was the main thesis why investors have been holding this stock for a few years. It will accelerate sales dramatically, analysts are saying, and even during this timeline when this drug was available, but that was a kind of like limited availability for some patients, it generated sales of about $200 million. Now analysts are seeing more upside, and that is the reason why the stock got a few upgrades in the past few days. Now it says it has about 18 buys, 3 holds, and 0 sells. Up to date, year to date, the stock is up by 65%, Katie.
Yeah, and currently looking at its best one-day performance since May 2023. We'll see if that one holds. Natalia, really appreciate that update. And let's zoom out to the broader market right now, because earlier this week, a number of strategists raised their year-end price targets on the S&P 500. The highest now sits at 6,000. And joining us now is the man behind the call. His name is Julian Emanuel. He is Chief Equity Derivatives and Quant Strategist over at Evercore. Great to see you in person.
Great to be here, Katie.
Let's talk about the big call heard around Wall Street, because you went from 47.50 to 6,000. Show your math here. What gets us to 6,000 by year end?
So I think when we step away from it, okay, and clearly this is something that there's an element of stepping out of one's comfort zone because we consider valuation to be a rather large part of the puzzle. But in going back and looking at history, valuation alone has not been a reason specifically to sell stocks. And frankly, in an environment where we think the AI revolution is really in its early stages, just an example here, we've been giving a series of webinars about macro topics for the last 6 months. And the company introduced an AI device about 2 weeks ago. We were able to take 45 minutes worth of a conversation and distill it in 3 minutes. And so for me, that was sort of a crystallization of how this technology is going to really enhance productivity. And so for us, the combination of that, the combination of the fact that we are, in our view, nowhere near a bubble, and the idea that past expensive markets have gone on for 1.5 to 2 years and have gone 40 to 60% higher. And this one is only 6 months old, based on crossing 20 times trailing earnings, and has only risen 11% from there. We think there's more to go.
I do want to get to the bubble talk, but let's talk about AI a little bit more and the revolution that is AI, because some of the themes that you're highlighting, you could have made that case at the start of 2024. So did anything change in the past couple months, or is it just your own experience with AI that really informed this?
Well, and to be fair, we did make the case throughout 2023. Actually, we were reasonably early to identifying the significance of it. But frankly, it's sort of anecdotal. It's talking with clients and corporates, and it's personal use that you can actually see the benefits accruing. And I think it's fair to say that that was the same sort of mentality that hit people in the late 1990s and the early 00s, even after share prices had turned down, with regard to the internet. And the long run implications for productivity are quite significant in our view.
And you mentioned that, I mean, high valuations are something that you kind of had to digest here. And I was actually speaking just casually with a portfolio manager yesterday, and we were talking about NVIDIA, and they haven't invested in NVIDIA yet. And they said, how do you buy NVIDIA right now? Basically at all-time highs, really briefly becoming the world's most valuable company. And I'm curious, I mean, how do you square FOMO versus really just the valuations? Do you just have to hold your nose and buy here?
So there are certain stocks, and that's certainly one of them, given the gains, where it's very difficult, particularly if you've got, a multi-week or a multi-month horizon. An entry point could be challenged here, but you really have to think about the long term and the implications of where the technology is going. And as well, when we talk about the stocks that we consider AI revolutionaries, we also include companies in other industries that have been very front forward about implementing the technology and showing how, A, it controls costs, but more importantly, how it actually engages and really elevates the customer connectivity experience.
Yeah, I do find that a fascinating narrative. The broadening of the AI rally, maybe not the overall rally, we haven't seen that yet, but just where AI could actually influence other parts of the market. Let's talk a little bit more about the underpinnings of this 6,000 call, though, because you also notched up EPS forecast from $231 for the S&P 500 to $238. Where is that growth coming from? Is that just tech?
To a large extent, it is right now. But when we look out, it's our expectation as we get into 2025 that we'll have a broadening, okay? We've seen a bit of a broadening over the last several months in terms of share prices participating, although small caps continue to lag a bit. But we actually do think as the economy continues on this sustainable path, if there is a minor downturn, the Fed will be there to, with plenty of ammunition to mitigate against the downturn. But B, the economy is on a path where we do think that earnings will broaden out.
Yeah, for better or worse, that Fed put, it still exists, it sounds like.
Look, for about a year and a half, the Fed wanted to say that it didn't, but frankly, and if you think about it, it continues to be an inflation story. And this environment is unique in that actually long-term rates have risen since the Fed's last hike last July. The market unusually is not looking towards a material slowdown, but yet the Fed is still there if inflation cooperates as we think it will.
Let's talk about bubbles. Like you said, this isn't a bubble, and we're lacking some pretty key ingredients here when it comes to M&A, for example, and when it comes to IPOs. We really still haven't seen those companies come out of the pipeline. What do you make of that?
Essentially, there could be a part of it is the capital markets are waiting to see what's going to unfold in Washington. This is, as we know, a reasonably consequential year for politics, and so that's an unfolding story. But again, it is part and parcel of most sort of climactic emotional rallies, which this one is not, that you do get M&A activity and IPO activity. And frankly, when you look at the bullish sentiment readings, they're not there yet either, which, again, is heartening to us.
And I feel like depending on how I wake up in the morning, I could feel like the lack of IPOs is either bullish or bearish, because it could be taken bullish as in, okay, we're not in a bubble. It could be bearish as in, what do these companies see that is keeping them out of the public markets, keeping them from leaving that pipeline? I mean, how has your view on that evolved?
Well, I think, look, the private markets have been very robust. We know that there's been swings in valuation over the last 4 or 5 years, but ultimately, you know, as in past cycles, the eventual strategy for a good swath of those companies will be going public. And we do think that that is part of the calculus. And then, of course, on the M&A front, there's just a huge amount of cash on hand in corporate America that, you know, whether it's AI-driven or just, you know, other forms of synergies, we do think that that cycle will reappear before this, you know, rally ends up peaking.
And Julian, before I let you go, I do want to talk a little bit more about private markets, because I'm having to pay a lot more attention to them, not just when it comes to private credit, but to that point, it feels like private markets are extremely hot right now and they're getting bigger. And obviously you live in public markets, but are you finding yourself paying attention more to those still private companies?
Well, you have to, and particularly on the credit side, because I think that you know, the shift towards credit, both public and private, has been very material since the pandemic, really driven by actually long-term rates going so close to zero as they did in 2020. And there will be liquidity issues at some point. There always are in every cycle, but we think we're a long way away from that. And frankly, the resilience of the credit markets has been part of this ongoing story of the rally in the stock market.
All right, Julian, I think that's a good place to leave it. Great to see you. Thank you for joining us on this Friday. That, of course, is Julian Emanuel of Evercore ISI. Now, coming up, we're going to dive into US PMIs next. This is Bloomberg. All right, the latest US PMI numbers just crossing the Bloomberg terminal, and it looks like a beat across the board. Let's get to Michael McKee. He is Bloomberg Chief Economics and Policy Correspondent. And walk us through these numbers, Mike.
Well, we've been hearing from a lot of people who think the economy is slowing and the Fed's going to have to act, but not with these numbers here. The manufacturing PMI from S&P comes in at 51.7, up from 51.3, and the services 55.1 from 54.8. The composite then ends up at 54.6 from 54.5. So still strength in manufacturing services and the overall economy, according to S&P Global. Now, this makes the U.S. an outlier with the rest of the world, because we got European PMIs today that did not look so good. Pretty much in every country, France, Germany, the UK, and the European Union as a whole, we saw declines. So in manufacturing services and composites. So it is not a particularly global effect. It's the U.S. as the strong outlier, Katie.
Yeah, and I mean, I feel like I keep asking you, when do we start to worry about growth in the U.S.? When do we go from worrying about inflation to worrying about growth? And I'm not really seeing it in these numbers at all.
Not today, at least. We'll try again next week if you want something to worry about.
And let's talk a little bit more about that divergence that we're seeing between the big global developed economies. You mentioned, of course, Eurozone activity. It slowed in the latest reading. And you think about the divergence in the economies going to lead to a divergence in the central banks, at least for the next couple months.
Well, the ECB, the European Central Bank, did cut rates once, but they're being reluctant in terms of trying to give people clues to another cut anytime soon. Their inflation story is a lot different from ours because they use the harmonized version of the CPI, which takes out much of the housing calculation the U.S. uses. If you did the same calculation, right now, the U.S. Headline CPI would be 1.95%. I did that calculation this morning. So they're in a completely kind of different situation. And then you got the United Kingdom as sort of an outlier on all of them because of the other issues they're having. And of course, the election's going to make a bigger splash than the Bank of England did this week.
Well, that's exactly where I wanted to go, because we talk about political and election risk when it comes to the U.S. all the time and how that factors into the Fed's thinking. Take us over to what's going on with France. How are we seeing that effect both in the economy and potentially at the central bank level?
Well, it's an interesting situation because basically Emmanuel Macron, when he called the snap election, they figured that the right, the Le Pen group the National Front would be the main challenger, but then the leftist parties all got together and formed an alliance. And so now he's got problems on both sides, and so do the markets, because the markets see both the far left and the far right as willing to spend a lot more money. And France is already in a deep deficit hole. So there are questions about what's actually going to happen. And the argument there is sort of the same as the argument here in terms of some of the politicians and their promises, that these are promises, don't worry, they're not going to happen. But it has boosted the spread between France and Germany and the yield curve, although when you look at it, France is only in the 3% range. The U.S. is well over 4% for its 10-year. So is it as bad? Well, we'll have to find out.
All right. Yeah, definitely something to watch there over the next couple weeks and months. Mike McKee, have a great weekend. Meanwhile, take a look at the market reaction to those US PMIs. Again, a beat across the board. You do see yields rise a little bit here, still lower on the day, but a little bit of a reaction in the bond market. Let's go back to the equity market, though. And for some of the sector price action, Abigail Doolittle joins us now.
So right now we're looking at the S&P 500 down slightly, down about 0.3%. More of the sectors are higher, including staples. That, of course, there was a defensive sector, as is healthcare and utilities, services, communication services, and discretionary and energy in there, but no big gains. What I really like to highlight is take a look at that tech weakness, down 1.1%. Now, a piece of this is NVIDIA. Today, down about 5%. Over the last 2 days, down 7.7%. The worst 2 days since April 19th. And if we take a look at what's happening for Apple, because that was another one that did an interesting reversal yesterday, actually that one right now is a little bit higher, offsetting some of that NVIDIA weakness and the AI weakness. Taking it to the week, Katie, let's take a look at some of the subsectors. So we are looking at an up week right now, at least for the S&P 500. We have the casino sector up 4.4%. Oil service index going up with energy up about 3%. But take a look at some of the weakness right there for that tech index. That is super interesting. I'm guessing, and I'm going to put it in as quickly as possible here, that the information tech index down on the week, down 1%. Most of that is coming from to today, and that is the worst week for tech going back to, well, it's actually not that far back, just 3 weeks ago. We also have real estate lower and the home builders down as well, Katie.
All right, Abigail Doolittle, thank you so much. Coming up, the market moving events you need to be watching next in our trading diary. This is Bloomberg. All right, it's time now for the trading diary. What you need to be watching today and next week. We get existing home sales at the top of the hour, and then next week on Tuesday, the World Economic Forum begins in China. Wednesday, we get May new home sales. Thursday, it's the first debate between President Joe Biden and challenger Donald Trump. And then we round out the week Friday with PCE. Meanwhile, you take a look at markets right now. The S&P 500 building on losses just about 30 minutes into the session. You can see currently down about 0.3%. And all those small cap gains we were talking about in the pre-market, they're gone now. The Russell 2000 down about 0.4%, and the NASDAQ 100, it's your laggard on the day. The NASDAQ 100 currently off by about 0.5%. Now, this was the countdown to the open. I'm Katie Greifeld, and this is Bloomberg.